Well, it's time for the personal finance corner, and today we're going to discuss tax-free bonds. So let's go across to Dhirendra Kumar for more on that. Dhirendra, hi, afternoon. Now, there are several tax-free bonds open in the market right now, and there are more bond issues in the pipeline as well. Since these instruments are very long-term, do you recommend investors choose the bonds over equity?
Investors should consider and look at these bonds very seriously, particularly those investors who are in the highest tax bracket and they depend on their income for investment for regular income. Because I think this is an extraordinary opportunity when these high-yielding bonds, available tax-free, close to 9% available tax-free, I would say is a decent return. Also, being having the predictability of these high returns on a tax-free basis over the next 10 years is not a bad idea. But I would say that this is not a comparable situation because when you invest in equity, you are not looking at regular income. You are looking at capital appreciation. For a 10-year period, equity is bound to deliver you more return, but it is unlikely to provide you regular income. So it serves the purpose. It is not a substitute for investing in equity. You are looking for income, you are looking for tax-free income, and you are looking for high income. Consider these bonds. If you don't depend on your investment for income and you are willing to take the equity risk and you have this time frame in mind, then invest in equity.
Right, bonds, Dhirendra, are normally compared to a fixed deposit, but if we also compare them to debt funds, do they still remain the best option?
Yes, bond fund, if we compare the bonds, the bond funds and the fixed deposit, I think bond funds and of course these bonds will score over fixed deposit simply because they are yielding higher return and they are tax free. But when you look at the liquidity and when you look at the convenience, the bank FD might still be a little more convenient, and it is available on tap. You have to really time your purchase of these bonds, while bank fixed deposits are available anytime. So it is a convenience and availability. And I look at these bonds as a special opportunity for fixed income investors. That apart, on the liquidity count and the tax efficiency front, bond funds are not. So you have to really combine the return, the tax efficiency, and the liquidity, and choose the one which fits your requirement. I think they all serve a purpose, and these bonds are a special situation. If you can compromise on the liquidity, and if you are looking at high income, and if you are in the higher tax bracket, these bonds could be very meaningful.
Dhirendra, first viewer query today is from Bennett Verghese, who has an SIP of 2,000 rupees rather, and it's in 3 months. The first one is Franklin India Blue Chip Fund Growth. The second one is HDFC Top 200. And the third one being HDFC Prudence Fund Growth. He wants to know whether he should continue with these funds or look at reallocation.
You are making these, your SIPs of 2,000 rupees each done over the past 12 months. I don't think this is a very nicely built portfolio. I would say that for somebody like you who is looking at 3 to 5 years time frame, I don't think for 3 years time frame you should be investing in equity at all. But assuming that you are going to do it for next 5 years and extend your period, I would say that consider our stable growth portfolio. They will be a better, superior choice for you because they will provide you stability and decent return as and when the markets turn around. In your portfolio, what I find is HDFC Top 200 and HDFC Prudence, and there is a great complement. The portfolios are very complementary. We have large overlap here. So I would say that consider our stable growth portfolio, or maybe just choose 2 or 3 funds from our stable growth portfolio that should do the job.